Do you remember how your parents saved for retirement in the 1970s? Not through apps or automated deposits or employer matches that magically appeared in digital accounts, but through thick pension booklets, actual paper bonds you kept in drawers, and savings accounts at banks where the teller knew your name. The 1970s were the last decade before retirement planning became something you actively managed on screens. And if you grew up watching your parents navigate their financial future during that era, you witnessed a completely different relationship between workers and their golden years. This was the age when companies still promised to take care of you, when Social Security seemed unshakably solid, and when planning for retirement meant trusting institutions rather than mastering investment vehicles. Let's walk through exactly how regular Americans built their nest eggs back then, because the methods weren't just different, they reflected an entirely different contract between employers, employees, and the economy itself. You worked for one company your entire life, and they promised you a pension. That's how most middle-class Americans approached retirement in the 1970s. And it wasn't just a nice benefit, it was the foundation of the entire system. When you got hired at a manufacturing plant, a utility company, or a corporate office, you didn't just receive a salary. You received a promise, printed in dense paragraphs across multiple pages of your benefits handbook, that if you stayed with the company for a certain number of years, usually 20 or 30, they would pay you a specific amount every month for the rest of your life after you retired. These were defined benefit plans, and the beauty of them was their simplicity from your perspective. You showed up, you did your work, and the company handled everything else. You didn't choose investments, you didn't watch markets, you didn't rebalance portfolios. The company's pension fund managers made all those decisions, investing your future pension dollars in stocks, bonds, and real estate while you focused on your actual job. Your annual benefits statement would arrive in the mail, a single page showing your years of service and your projected monthly pension amount. And that number was calculated using a formula based on your salary and tenure. If the statement said you'd get $800 a month at age 65, you believed it because the company had made that promise. And breaking E, a pension promise was almost unthinkable. The entire culture reinforced this trust. Your parents probably had pensions, your neighbors had pensions, and when someone retired from the local plant with their gold watch and their pension locked in, everyone understood that person had won the American dream. Can you remember your parents talking about their pension the way people today talk about their 401k balance? Social Security wasn't just a safety net, it was the other half of your retirement plan. In the 1970s, Social Security benefits were robust enough that combined with a modest pension, they could genuinely support a comfortable retirement. You paid into the system with every paycheck, watching that FICA deduction reduce your take-home pay, but you did it with confidence, because everyone told you Social Security was rock solid. The program had been around since 1935. It had survived the Depression and multiple wars, and by the 1970s, it was paying benefits to millions of retirees who seemed to be living proof of its reliability. The typical American worker assumed their Social Security check would cover basic living expenses, rent or mortgage, utilities, groceries, while their pension would fund everything else. People would actually sit at kitchen tables with pencils and paper, adding up their expected Social Security payment and their projected pension, then comparing that total to their current expenses to see if they could maintain their lifestyle. The math usually worked because housing was often paid off by retirement, kids were grown and gone, and retirees in the 1970s genuinely lived more simply than working families. You'd see retirees stretching their Social Security checks by shopping sales, growing vegetables, and taking advantage of senior discounts that actually meant something, 10% or 15% off at restaurants, movie theaters, and stores. The system worked because the ratio of workers to retirees was favorable, because benefits were generous, and because most people didn't live as long after retirement as they do today. When your grandmother said she was living on Social Security, she wasn't describing poverty. She was describing a viable retirement funded by the program. Do you remember when Social Security seemed like something you could actually live on? You bought U.S. savings bonds and you kept them in an actual drawer. This was the third pillar of 1970s retirement planning, especially for people who wanted to save beyond their pension but didn't trust the stock market or didn't have access to other investment vehicles. Savings bonds were pure Americana, backed by the full faith and credit of the U.S. government, marketed with patriotic imagery and sold at banks, post offices, and even through payroll deduction programs programs at many employers. You'd walk into your local bank, speak with a teller who might remember your kids' names, and purchase a Series E or Series EE savings bond with cash. The bonds came as actual paper certificates, beautifully printed with ornate borders and official seals, showing the purchase price, the face value, and the maturity date. If you bought a $50 bond, you might pay $37.50 for it. And then, over the course of several years, it would mature to its full $50 value. That difference was your interest. The interest rates on savings bonds in the 1970s were actually competitive, sometimes reaching 6% or 7%, which sounds modest now, but felt substantial then, especially since the interest was exempt from state and local taxes. People accumulated these bonds slowly and deliberately, buying one every few months with spare cash, and they'd store them in desk drawers, safety deposit boxes, or fireproof safes at home. The tangible nature of savings bonds made them feel secure in a way digital investments never would. You could hold your retirement savings in your hands, count the certificates, and show them to your spouse while planning your future. When the time came to cash them in, you'd return to that same bank with your stack of bonds, sign the back of each one, and receive a check or cash. The whole process was slow, physical, and built on trust in government institutions. Can you picture your parents' dresser drawer with those cream-colored bond certificates rubber-banded together? You had a passbook savings account at your local bank, and you actually watched it grow. Before money market accounts and high-yield online savings, there was the passbook savings account, and it was how millions of Americans accumulated emergency funds and supplemental retirement savings throughout the 1970s. Your passbook was a small booklet, usually burgundy or forest green, with your name embossed on the cover and rows of columns inside where tellers would manually record every deposit, every withdrawal, and your running balance. Each time you went to the bank, which you did regularly because there were no ATMs, no online banking, no apps, you'd hand your passbook to the teller along with your deposit slip, and they'd update the booklet right there while you waited, using a special printer that stamped the transaction details onto the next available line. Then they'd hand it back, and you'd glance at that new balance, feeling the concrete satisfaction of watching your money grow. The interest rates on passbook savings accounts in the 1970s started modestly, around 4% or 5% at the beginning of the decade. But as inflation surged, rates climbed too, sometimes reaching 8% or even higher by the late 1970s. That interest compounded quarterly, and the bank would print the compounded interest directly into your passbook on specific dates, so you'd see your balance jump without making any deposit. The entire experience was tactile and visual. You could flip through your passbook and literally see your savings history, tracking your progress over months and years. People treated their passbooks carefully, keeping them in safe places, because losing your passbook was genuinely problematic before computers tracked everything. These accounts weren't glamorous, but they were reliable, FDIC insured, and perfect for people who wanted to save for retirement without taking risks. Do you remember the smell of that passbook, the specific texture of its pages? You might have invested in whole life insurance as a retirement vehicle. This sounds strange to modern ears, where term life insurance dominates and financial advisors warn against mixing insurance with investing. But in the 1970s, whole life insurance policies were aggressively marketed as dual-purpose products that would both protect your family and build cash value for retirement. The pitch was compelling. You'd pay premiums every month or every quarter, and while part of that money went toward the death benefit that would protect your spouse and children, another portion accumulated in a cash value account that grew tax-deferred at a guaranteed rate. After decades of premium payments, you could borrow against that cash value in retirement, essentially using your own policy as a personal bank. Or you could surrender the policy entirely and take the accumulated cash as a lump sum. Insurance salesmen, and they were almost always men in the 1970s, would visit your home in the evening, spread their charts and projections across your kitchen table, and show you illustrated scenarios where your $50 monthly premium could grow into tens of thousands of dollars by retirement age. The guaranteed growth rates were modest, often around 3% or 4%, but the policies also paid dividends based on the insurance company's performance, and those dividends could be reinvested to buy additional coverage or boost your cash value. The whole system felt safe and automatic. You wrote your premium check every month just like you paid your mortgage, and the insurance company handled everything else. The downsides were significant, though most people didn't realize them. The fees were high, the actual returns were often mediocre after costs, and the early years of premiums went almost entirely to commissions rather than cash value. But in an era before 401ks and IRAs dominated retirement planning, whole life insurance filled a psychological need for people who wanted forced savings and guarantees. Do you remember Remember those insurance salesmen with their leather briefcases and projection charts? You bought stocks through a stockbroker who charged substantial commissions. If you were among the minority of Americans who invested directly in individual stocks during the 1970s, and it was a minority, maybe 20% or 25% of households, you did it through a relationship with a human stockbroker, not through a free app on your phone. You'd call your broker on the telephone, often at a major firm like Merrill Lynch, E.F. Hutton, or Shearson Lehman, and you'd tell them you wanted to buy 100 shares of General Electric, or IBM, or AT&T. Your broker would execute the trade on your behalf, and weeks later, you'd receive an actual stock certificate in the mail, an ornate piece of paper with fancy borders, the company's name emblazoned across the top, and your name written in as the registered owner. These certificates were beautiful objects, printed on heavy paper with intricate anti-counterfeiting designs, and people stored them in safety deposit boxes or home safes. But the costs were substantial. Commissions in the 1970s could easily run $50 to $100 per trade, sometimes more, which meant you needed to make significant gains just to break even. This commission structure naturally discouraged active trading and encouraged a buy-and-hold mentality that actually served retirement savers well. You bought stocks you believed in, blue-chip companies with long histories and steady dividends, and you held them for years or decades, collecting dividend checks that arrived in the mail quarterly. Those dividend checks were real paper checks that you'd deposit at your bank, and they represented tangible returns on your investment in a way that today's automatic reinvestment doesn't quite capture. The entire process was slow, expensive, and required either substantial capital or serious commitment, which is why most working-class Americans stuck with pensions, Social Security, and savings accounts instead of trying to play the stock market. Can you remember those ornate stock certificates, the weight of them in your hands? You might have joined a credit union and benefited from higher savings rates. Credit unions were the financial underdogs of the 1970s, member-owned cooperatives that often paid better interest rates on savings and charged lower rates on loans than traditional banks. If your employer had a credit union, or if you were eligible through a union membership, a religious affiliation, or a community organization, joining that credit union was one of the smartest financial moves you could make for retirement savings. Credit unions operated differently than banks. They were nonprofit, they were governed by member boards, and they returned their earnings to members through better rates rather than paying stockholder dividends. Your savings account at a credit union might earn 6% or 7% when the bank down the street only paid 5%, and that difference compounded dramatically over the decades you were saving for retirement. Credit unions also offered specialized retirement savings programs, often called Christmas clubs or vacation clubs, where you'd commit to depositing a fixed amount every week or month, and the credit union would hold that money in a separate account that matured at a specific time. These forced savings programs were surprisingly effective because they created structure and discipline, and because the credit union's physical location, often right at your workplace or in your neighborhood, made deposits convenient. The culture at credit unions was different too. Tellers knew members by name, loan officers would work with you through financial difficulties, and the entire institution felt more like a community resource than a profit-driven business. For retirement savers in the 1970s who had access to a good credit union, membership often meant the difference between adequate savings and truly comfortable retirement nest egg. Do you remember your parents' credit union passbook, maybe with a different color than their bank passbook? You invested in certificates of deposit when rates soared in the late 1970s. As inflation ravaged the economy in the latter half of the decade, interest rates climbed to previously unimaginable heights, and suddenly, certificates of deposit, CDs, became one of the most attractive retirement savings vehicles available. By 1979 and 1980, you could walk into your local bank and purchase a CD paying 12%, 14%, even 16% annual interest, rates that seem impossible by today's standards. The mechanics were simple. You agreed to leave a specific amount of money, usually at least $500 or $1,000 on deposit for a fixed term, typically 6 months, 1 year, 2 years, or 5 years, and in exchange, the bank paid you a guaranteed interest rate that was substantially higher than regular savings accounts. The catch was the early withdrawal penalty. If you needed your money before the CD matured, you'd forfeit months of interest, sometimes all the interest you'd earned. But for retirement savers who knew they wouldn't need to touch that money for years, CDs were perfect. Completely safe, FDIC insured, and paying returns that actually outpaced inflation during a time when inflation was eating away at purchasing power. You'd receive a paper certificate when you purchased a CD, showing the amount, the rate, and the maturity date. And when that CD matured, you'd face a decision: cash it out roll it into a new CD at whatever the current rates were, or let it automatically renew. Many retirement savers built CD ladders without even knowing the formal term for it. They'd stagger their CDs with different maturity dates so that one would come due every few months, giving them flexibility while still capturing those high rates. The late 1970s CD boom created a generation of savers who experienced double-digit returns on completely safe investments, something that shaped their expectations for decades afterward. Can you remember your parents talking about their CDs maturing, marking the dates on the kitchen calendar? You contributed to a Keogh plan if you were self-employed. Long before SEP IRAs and solo 401ks became the standard retirement vehicles for entrepreneurs and freelancers, there was the Keogh plan, named after the congressman who championed its creation in 1962. If your father ran his own business in the 1970s, maybe he was a doctor with a private practice, a shopkeeper, a consultant, or a freelance contractor, he probably had a Keogh. These were qualified retirement plans that allowed self-employed individuals to defer taxes on retirement contributions, just like corporate pension plans did for employees, but the paperwork was notoriously complex. Setting up a Keogh required working with an accountant or lawyer, filing specific forms with the IRS, and maintaining detailed records that met federal requirements. The contribution limits were actually generous for the time. You could shelter a significant percentage of your self-employment income, sometimes up to $7,500 or more annually, depending on the plan type. But the administrative burden scared away many small business owners who could have benefited. Still, for self-employed professionals who took the time to establish and maintain a Keogh, the tax advantages were substantial, and the forced discipline of making those annual contributions built retirement savings that pensions would have provided if they'd worked for someone else. Your contributions went into investments you selected, usually mutual funds, stocks, or bonds held at a brokerage or bank, and they grew tax-deferred until retirement. The plans came in two flavors: defined contribution Keoghs, where you contributed a set amount each year, and defined benefit Keoghs, where you worked backward from a desired retirement income to determine current contributions. The defined benefit version was especially complex, requiring actuarial calculations, but it allowed much higher contribution limits for high earners approaching retirement. Keoghs represented the 1970s answer to retirement inequality between employees and the self-employed, though the complexity meant many eligible people never bothered. Do you remember your self-employed father or uncle talking about their Keogh contributions at tax time? You might have invested in real estate as your retirement nest egg. For many Americans in the 1970s, their home wasn't just shelter. It was their primary retirement investment strategy. The logic was straightforward. You bought a house with a 30-year mortgage, you paid it off by retirement, and then you either lived mortgage-free on your pension and Social Security, or you sold the house and downsized, pocketing the difference to fund retirement. But beyond primary residences, the 1970s saw a surge in Americans buying rental properties, vacant land, and vacation homes specifically as retirement investments. Interest rates were climbing, but so were property values, and real estate felt tangible and controllable in a way that stocks and bonds didn't. You could drive past your rental property, you could collect rent checks in person, you could fix problems yourself, and you could see the neighborhood changing around your investment. The tax advantages were significant too. Mortgage interest was deductible, property taxes were deductible, and depreciation on rental properties created paper losses that sheltered other income. People would buy a duplex or a small apartment building with the explicit plan of having the renters pay off the mortgage over 20 or 30 years, so that by retirement, the property would be fully paid and throwing off rental income every month. The strategy worked beautifully for disciplined investors who bought in appreciating areas and who could handle the landlord responsibilities, collecting rent, managing repairs, dealing with difficult tenants. It worked less well for people who bought emotionally, who overpaid, or who couldn't handle the illiquidity when they needed cash quickly. But in the 1970s, before REITs became widely accessible to average investors, direct real estate ownership was how regular people added property exposure to their retirement planning. The closing process was slower then. The paperwork was all physical, and you'd walk out of the title company with actual deed documents that you'd file carefully away. Do you remember your parents talking about their rental property as their retirement plan? You participated in profit-sharing plans at forward-thinking companies. While traditional pensions were the norm, some companies in the 1970s, particularly in growth industries like technology, retail, and manufacturing, offered profit-sharing plans as supplements to or replacements for traditional pensions. pensions. These plans were fundamentally different from pensions because your retirement benefit wasn't guaranteed. Instead, the company contributed a percentage of its profits into individual accounts for employees, and your account balance depended entirely on how well the company performed and how those contributions were invested. In good years, you might see substantial contributions. In bad years, you might see nothing at all. The contributions were typically based on a formula tied to your salary and the company's profitability, and they'd appear as line items on your annual benefit statement showing your account balance growing. Unlike pensions, where the company bore all the investment risk, profit-sharing plans shifted that risk to you. Your account was usually invested in a mix of stocks, bonds, and money market funds, and the value fluctuated with the markets. But profit-sharing plans also offered something pensions never could: portability. If you left the company, you could often take your vested balance with you, rolling it into an IRA or your new employer's plan, rather than losing unvested pension benefits or waiting decades to collect a reduced pension. The vesting schedules varied. Some companies vested you immediately, others required 5 or 10 years of service. But once vested, that money was yours. Profit-sharing plans in the 1970s were essentially the bridge between the old pension world and the coming 401k revolution, training workers to think about individual account balances and investment performance rather than guaranteed monthly checks. Companies like Sears, Procter & Gamble, and Eastman Kodak had notable profit-sharing programs that created substantial retirement wealth for long-term employees. Do you remember your parents tracking their profit-sharing balance, watching it grow year by year? You bought municipal bonds for tax-free retirement income. For affluent savers in higher tax brackets during the 1970s, municipal bonds, munis, represented a sophisticated retirement strategy that combined safety, income, and tax advantages. These were bonds issued by state and local governments to fund infrastructure projects like schools, highways, water systems, and public buildings, and the interest they paid was exempt from federal income tax, and often from state tax if you bought bonds issued by your home state. The tax exemption was crucial in the 1970s, when federal marginal tax rates reached 70% for top earners, making the effective yield on munis far superior to comparable taxable bonds. If you were in the 50% tax bracket and you bought a municipal bond paying 6% tax-free, the taxable equivalent yield was 12%. You'd need to earn 12% on a corporate bond to match it after taxes. The buying process required working with a broker who specialized in fixed income securities, and you'd typically purchase bonds in $5,000 denominations. You'd receive actual bond certificates in the mail, beautifully engraved documents showing the issuing authority, the interest rate, the maturity date, and the coupon payment schedule. Twice a year, interest coupons would come due, and you'd either clip the physical coupon from the bond certificate and mail it to the paying agent, or later in the decade, receive interest payments automatically. Retirees would build municipal bond portfolios specifically designed to generate monthly tax-free income by staggering the coupon payment dates, creating a stream of checks that supplemented their pension and Social Security without increasing their tax burden. The strategy required substantial capital. Building a diversified muni portfolio might require $50,000 or more. But for doctors, lawyers, business owners, and executives saving for retirement, munis were the intelligent choice. The bonds were considered extremely safe because municipal defaults were rare, and they represented a way to lend money to your own community while building retirement wealth. Do you remember your financially savvy uncle clipping bond coupons at his desk? You enrolled in thrift savings plans if you worked for the government. Federal employees in the 1970s didn't have traditional pensions like private sector workers. Instead, they had the civil service retirement system, which was actually more generous than most private pensions, but they also had access to something called thrift savings plans years before the private sector got 401ks. These weren't quite the modern thrift savings plan that federal workers know today, but they were government-sponsored savings programs that allowed employees to contribute a portion of their salary into tax-advantaged retirement accounts. The contribution limits were modest by today's standards, and the investment options were limited, usually just government securities and maybe a conservative stock fund. But they represented early recognition that workers should be able to supplement their pensions with personal savings. The government sometimes matched a portion of employee contributions, creating an incentive to participate that many workers took advantage of. You'd enroll through your personnel office, filling out paper forms that authorized payroll deductions, and you'd receive quarterly statements showing your account balance. The money came out of your paycheck before you saw it, creating the same forced savings discipline that makes modern 401ks effective. State and local government employees often had similar programs, sometimes called deferred compensation plans, that operated on parallel principles. These government thrift programs were essentially the laboratory where policymakers and benefits designers tested the concepts that would eventually become universal in the private sector after 1978, when Congress passed the legislation creating 401ks. Federal workers who maximized these programs throughout the 1970s, combining them with their civil service pensions and Social Security, often retired with genuinely comfortable financial security. The 1970s were the last decade when retirement planning was primarily about trusting institutions rather than managing investments. Your company promised to take care of you with a pension. The government promised Social Security would be there. Banks, insurance companies, and bond issuers made guarantees you believed. The tools were simpler: passbooks, paper bonds, stock certificates you could hold. And the strategies were more passive. You didn't check portfolio balances daily, you didn't rebalance asset allocations, you didn't stress about sequence of returns risk or safe withdrawal rates. You worked, you saved what you could, you trusted the systems that had worked for your parents, and you hoped it would all be enough. For many people, it was. For others, the inflation of the late 1970s eroded their savings, or their company's pension promise eventually broke, or they discovered too late that they should have saved more. But the fundamental difference between then and now wasn't just the tools or the accounts, it was the psychology. Retirement in the 1970s was something that happened to you based on systems outside your control, not something you actively managed and optimized. That world is gone now, replaced by one where you're responsible for every contribution, every allocation, every decision. Whether that's progress or loss depends on who you ask. But either way, something fundamental changed after the 1970s ended. If you remember these methods, if you watched your parents navigate this system, drop a comment and tell us which of these strategies they used. And if you found this journey back in time valuable, check out other interesting videos on your screen. Thanks for remembering with me.